I would say I also challenge people, do they want to be fund managers? Especially if they're angels. Being an angel, it's definitely less work. So it's really something you're going to want to align long-term around if you want to do the fund manager.
Welcome to Tank Talks, a podcast that brings you insights and stories from some of the best and brightest minds in technology and investing. I'm your host, Matt Cohen, founder and managing partner at Ripple Ventures. On this week's episode, we welcome Mead, the founder and CEO of Coolwater Capital, to discuss demystifying VC fundraising and the ways in which Coolwater helps emerging managers become established managers. Winter shares his journey starting out at Sapphire Ventures, where he learned the ropes of venture capital and fund investing at one of the biggest fund investors. Next, Winter explains why he decided to write a book about how to raise a venture capital fund and the process he went through to create such a guidebook. Winter and I delve into the essential strategies, common challenges, and best practices in navigating the fundraising landscape and how Coolwater Capital helps shape the next generation of venture capital leaders through its training and network building programs. Finally, we discuss the role technology is playing in raising and managing a venture capital fund today and what his long-term vision is for Coolwater Capital. But before we jump into this week's interview, we welcome back to the tank John Ruffolo to discuss the news and stories making headlines in the tech and venture capital ecosystem. All right, John, welcome back to the tank. How you been?
Great, man. How are you?
I'm pretty good. You know, the capital gains headlines still continue to take time in the news. This time, a little bit of political gamesmanship, maybe I would call it, where our great Minister of Finance, Chrystia Freeland, submitted the budget bill motion forward without the capital gains tax included. So the proposal did not include things like the inclusion rate going up from 1/2 to 2/3, an increase in the lifetime capital gains exemption, and the new incentives for entrepreneurs, which have obviously gained significant backlash from country's tech leaders, including yourself. So what is going on here?
No one knows specifically other than the government, but let me surmise what I think is happening here. And I think there might be a two-pronged reason. The first prong is it might just simply be political by removing this clause out and forcing the conservatives to make a stand on the capital gains tax. Perhaps they might be soliciting those unaffected folks on the capital gains to put the conservatives in a corner, saying, "Oh, they only support the wealthy class and not the folks that are struggling." Although, if that is the case, that might also backfire as well. That's number one. Number two, which I hope is more the reason, but again, I don't know. Even if there is no reversal on this capital gains strategy, the minister has indicated a willingness to tinker with some of the rules, and they haven't drafted the rules in detail, and they do need some time to both draft them, and if there is tinkering, they need a little bit of time. The June 25th date is still looming large there, and who knows, maybe it'll be extended, or maybe there will be a mad dash to ensure that it's done beforehand.
It does seem like the straightforward reason for not having the capital gains tax included is that you're right. They just haven't figured it out yet. They haven't written out the implementation bill that would allow this to actually be orchestrated. But the other time is when she was confronted by journalists, she kind of dodged the question and said that they're very committed to the capital gains measures that they put forward in the budget, but they're still working on the implementation legislation. And then, basically when asked if she did this exclusion, to force the conservatives to vote on it, she said no, and then kind of smiled. So I don't really know if this is a bit of both. It could be a bit of both.
I think it could, and I'll tell you why I think it could be a bit of both. So let me give you some good news. And again, I've said this before, there are some good elements in the budget, which kind of saddened me that the capital gains kind of overrode any of the good stuff in the budget. But one of the things is on the shred. Well, the reason why the details of the shred also were not released is they decided to add another $600 million to the kitty. And what the minister did say is they needed some time to figure out what the rules will be so that they could expand that usage, and they didn't have enough time. So they are also working frantically hopefully in the next month or so in order to release the new SR&ED rules as well.
I mean, it just feels though like they're fighting so many fires, this government. They just asked for another $300 billion, I believe.
Yes.
In debt ceiling. And then they've got these poor housing start numbers. I'm not sure if you caught the other great John on their news rundown last week.
Yes, I did.
John Love of Kingset Capital. But obviously we talked a lot about this. And, he says we haven't had housing starts as good as we had back in the 70s.
Right.
And now, again, the numbers come out and show just a pure weakness around delivering on these housing bets a year or two out.
What's interesting on that is that I think you and I had this debate before, people arguing that there was a demand issue on housing. For God's sakes, it's been a supply issue.
Forever.
For forever. And the unlimited immigration, while we both champion it, it damages already a horrible situation. And so having then the government coming in with spending when the real problem is unconstrained immigration and there's no place to live, it does feel a little bit hollow here on that. And, the last thing I would just say is when you keep on saying fairness for future generations, really? That's a monstrous debt load. And I don't know about you, but the future generations are going to pay for this excess. And I don't know how.
Yeah, I can't wait for my 9-month-old to have to start paying for this debt when they're 9 years old. It's kind of crazy. And also, I don't know if the government is just listening to our podcast, because there are so many things that we talk about, publicly about when they're announced, and then they go back and change them. For example, on the John Love podcast, we talked about how the largest contributor to GDP, the public sector, is still on a remote hybrid work policy. And then sure enough, yesterday, they announced that all federal public servants will be expected back in the office 3 days a week, going from a twice a week hybrid model to back in the office 3 days a week. I just feel like there's a lot of things that logically should have been done way long ago that are now just starting to, change course because the pressure on the government from the public is just too much for them to handle, especially heading into an election next year.
Again, I'll reiterate, folks, let's stop dividing one another. It's all of us together. We all got to fight together on here. And, the last thing I would just say is whenever we're looking at solutions, just like in our businesses, you could only cut costs once. But if you're growing the revenues, you can keep on getting the benefit of the revenue increases every year. It's the same thing in our nation. Let's focus in on growing the pie as opposed to redistributing and pitting one class against another and then fighting over the crumbs. This is not a way to build prosperity for the future. And that is the narrative and really central concern that we just really got to stop as a nation.
Absolutely. Switching gears here, speaking about our businesses, the first quarter numbers came out from Carta on the state of the private markets for Q1 2024. And what they're saying is valuations rose, but not for later stage companies. And the median pre-money valuations ticked upwards for most venture stage deals, albeit on low volume for Series D and E plus rounds. So, some things that we're seeing, I don't know if you are seeing the same thing, but a lot of bridge rounds are happening from Series A and beyond.
Yes.
And these bridge rounds are mostly being done by insiders who are trying to obviously prop up or give companies that raised in 2021 or 2022 a little bit more breathing room to quote unquote figure it out. But eventually everything's going to come home to roost. And so just to give our audience a sense of what's happening, Series A valuations leveled off in Q1. The median pre-money valuation, I believe was around 40 odd million, for Series A valuations, which is still quite high, compared to obviously back in, 2020 days, but much higher than it was at the bottom of 2022. And then, the price seed rounds are definitely getting a lot bigger. It feels like the seed round and the Series A round, traditional Series A rounds, are kind of being combined together, where companies don't have to raise two lockstep rounds. They're getting to raise one larger seed round together. And that sits around 9.3 million. And then, the growth rounds, they're starting to tick back up again on lower volume. but in Series C land, instead of those peak 400, $500 million rounds that we saw at the top of ZERP days of 2020, 2021, we're now at the 190, $200 million Series C rounds, and Series B rounds are sitting, I believe, around 100 to 115 million, up from an $80 million low at the bottom. Does it resonate with what you're seeing in the growth stage market and how things are starting to tick up and round sizes are starting to pick up from the bottom of the market?
Yeah, I would say there is a bit of a tale of two worlds there. And I think that this market needs a little bit of a bifurcation on the AI investments versus the non-AI. The AI investments are still at monstrous valuations, although they're starting to get a little bit of softness in there too as well. And that's driving up the average. So when you take away on the AI rounds, the bid-ask spread between buyer and seller, that gap has almost fully closed. And I would say about a quarter ago, around Christmas time, is when we started to see valuation starting to get more in line with the long-term mean. And the other thing I would say is you can also see the valuations being far more favorable to not the growth at all costs, but those businesses that seem to have a path forward to profitability. So that's what we've been seeing. The only other thing I would add into your stats is it's a bit of a leading indicator is where the capital is being raised. And if you look in the United States, and it's still early in the year, but only two firms, being I think Andreessen and General Catalyst, raised 44%, just those two funds, of all venture capital raises in the United States this year so far. That is an unbelievable amount of concentration, which suggests that there'll be fewer sources of capital, which might suggest that the pricing on competition for capital might continue to be muted for the next few years.
Yeah, absolutely. I mean, speaking of capital, I'm not sure if the Cohere PSP deal is closed yet, but wow, did Llama 3 drop a gauntlet on the foundation frontier model building space the other week? Did you see how fast it rose on the top ranking of Hugging Face and the cost difference between Llama 3 and GPT-4?
No, I didn't see how fast. So share, please.
Yeah, so Llama 3 came out the other week. Meta, obviously the creator of it, released this, and it rose very quickly. They had three models that they released. The problem that people were saying was that it was a smaller token count. So I believe it started at 8,000. But because it's an open source model that they're giving away for free, it already increased its token size significantly within the first 24 hours, and it keeps doubling.
Oh, wow.
And so
is the viral effect. Wow.
People are saying, this is what, Mark Zuckerberg has always done, which is scorch earth, right? Giving away what people think is their technical moat for everyone else in the community to benefit from, and then using, their network of apps to basically dismantle anyone who wants to charge for this, so that, $20 a month just went down to $1 or something for OpenAI or Google. And the quality of this model that they've given away for free is already being embedded. If you've seen in any of your Meta apps, you've got WhatsApp, you've got Facebook, you've got Instagram, that little blue circle at the top of every search box is that new model that was released, and it's quite powerful. So people are questioning whether or not, this really disrupts a lot of the frontier models, business models, whether it's OpenAI, whether it's Cohere, whether it's Anthropic. How do you compete when, Zuckerberg just says, I'm going to dump, I think it was like $45 billion
yes.
at this thing? There's countries don't have that much to invest in this stuff.
And Matt, this is consistent to our discussion many months ago at the infrastructure level of the LLM infrastructure level. We both believe that we're going to end up in a rule of three where it's going to be commoditized and there's going to be three massive global players. And, at the time we both said, geez, OpenAI looks like they're in good spot. And it looks like that Google might be in a position too, which leaves maybe one more spot open. And Facebook was nowhere to be found. So it will be interesting. And this is part of the challenge of these massive winner take all situations where it really inhibits a lot of the competition from other firms. So I think that we're still in such early innings, but yes, that really threw a wrench into the analysis.
I mean, just an open source model that can learn around itself with the community obviously playing and tinkering with it.
Right.
How do you compete as a closed model system like OpenAI on a business level when people are just going to, one, say, I'd rather just download this into my private environment and use it myself and not have to be connected? Or, if you're not even an enterprise that cares so much about security, just cost, Llama 3 is 10 times cheaper to run than it is on GPT-4. So the cost structure alone, besides the open sourceness and the ability to run it in your own environment, there's just so many ways in which I guess Zuckerberg continues to demonstrate how much he understands businesses along the entire value chain versus ones that come out with one really big swinging advantage that he can basically undercut within how long does it take?
Yeah.
They said it was a couple months.
Yeah. And by the way, he's not a monopolist either, and he embraces free enterprise. So there you have it.
There you have it. Awesome. We'll have to see how this plays out. Thanks again for joining us in the tank today, John.
All right. Thanks, Matt.
Now let's jump into the tank for this week's episode with Winter Mead from Coolwater. Thanks for joining us in the tank today, Winter.
Matt, thank you.
Winter, your journey into the venture capital world and investing world seems to be centered around your time spent growing up in the Bay Area. But for our listeners who may not be so familiar with you, it'd be great if you can kick things off with a brief background on yourself, your upbringing, and your early career path.
Grew up in New England on a farm, went to school in Boston, then England, and moved to the Bay Area during the last recession, so 2008-9 period. Worked at a couple of startups. That was the big reason to move to the Bay Area. Some advice from some professors that if you wanted to do technology, the Bay Area was the place to do it. I don't think that was bad advice. And yeah, spent the last 15 years there doing a little bit of operating, doing a little bit of investing, and doing a little bit of building.
You spent some time at Sapphire Ventures, which some people may know as the investment arm of SAP, but that's a pretty great place to build the foundations for thinking about investing and, the ideologies around venture capital. What was your time like there? And what was some of the best parts of spending those early days working at Sapphire and the exposure you got to probably so many amazing GPs?
It was a great experience. I'd say even the more foundational work for listeners, I did a couple of internships in finance, right, in different assets. So fixed income was one of my internships, and I also did one in the public equity space was another one. And then before I joined SAP, was at a multifamily office wealth manager out of San Francisco called Hall Capital Partners. Before Hall, it was Offit Hall. Before Offit Hall, it was Laurel Capital Management. There, they took a multi-asset class approach to business. So I think it kind of helped that I had a experience doing fixed income and experience doing kind of public equities underwriting. And then I joined the private equity team there. I think that was a lot of foundational work of thinking about investments across asset classes and also thinking about what is private equity, right? Because people say private equity, but it means different things. It can mean growth investing, it can mean distressed investing, it can mean buyout investing, it can mean venture capital. So that was kind of the foundational elements. And then, the Sapphire SAP opportunity was interesting because I had this foundational layer of what I thought I knew about investing. And I had the opportunity to kind of double down in something I thought was very compelling within the private equity realm, which was venture capital, right? And so I think that's where I learned a lot at SAP, which was being part of a now 10 billion, maybe more in AUM size venture capital firm, helping build as an entrepreneur a new strategy there, which was fund to funds investing into VC. And that's where I think I really went deep on venture capital, within private equity. Yeah, just being at a tier one VC firm and sitting around the investment committee table and learning from a lot of great investors that generated value for our LP was a pretty fascinating, very worthwhile experience.
Yeah, it's so great to hear you talk about that foundation layer that you got being a part of the investment side, the public market side, the underwriting, and also at the family office side, which is all about really wealth preservation. I had a similar experience growing up, in capital markets and working on the trading desk on Wall Street for the Royal Bank of Canada. And you could literally walk from one portion of the trading floor to another and cross like 5 different asset classes and trading strategies and hear all the different conversations that were happening between fixed income, between derivatives, between equities and quant trading and all those different things. And so having that wide open aperture towards where actual capital goes and flows and decisions are made is so important, because a lot of times in venture capital, I see this all the time, it's pure blinders, right? It's venture capital or nothing. And when you have these conversations with LPs, especially sophisticated LPs, they have so many different conversations all the time with different asset managers and different asset classes that you need to respect that and understand where they're coming at things from. What did you see, especially at Sapphire, though? Because that's like a place where you see a lot regarding private equity and venture capital that made you fall in love with the space.
Yeah, like I said, I kind of fell in love when I was at Hall and kind of, doubled down when I was at SAP. But to just touch on what you just said, right? Like, I think you're right. Like, talking to a lot of people, like sometimes the conversations in VC, there is a little bit of a bubble and it feels like there are blinders on, to your point. Being able to step outside of that is helpful, right? And that's what I mean when I say multi-asset class perspective. Like, understand how LPs are thinking about the world, and to your point, how they're getting pitched and what they're investing into and why they're finding those investment opportunities compelling. It even makes you a better VC, right? And I think it really helps you like hone in on like what's a strong strategy for you as an investor in technology if you're a venture capitalist. So everything you just said, like, it really resonates.
No, I just went to a family office conference last week, and I can tell you venture capital was maybe mentioned once or twice. It was all about hedge funds and private credit, foreign exchange and emerging markets and things like that. Like, it was not the top of the conversation a lot of family offices were asking about on the panels.
Yeah, and another thing to think about there, right? Like, it's adjusting to the market. It doesn't necessarily take you away from VC, or you're not leaving VC, but going from a 2021 market to a 2024 market, you may change strategies. You're still investing into early stage, but maybe early stage venture capital, but maybe you're doing it through secondaries versus primaries, right? Or maybe you're doing it by, buying out and over like other portfolios versus like you being the portfolio manager, right? Or maybe you're thinking about cap structures in venture capital and like buying kind of the debt associated with the equity investment, at a discount versus like, again, being kind of the kind of equity holder in the business. So being open-minded and having like these in-depth conversations with family offices and people that are investing actively into venture, and being a bit more like flexibly minded about like what your strategy could be as the market changes. Like, I don't think you're going black to white and vice versa. Like, you're not completely changing your strategy, but you are like honing in on kind of these market nuances and really creating an investment strategy around like trying to, generate value and capture value for your LPs. And I think if you just do what everyone else is doing in the market, sometimes that can make it more competitive for you and maybe make you less successful. So I would encourage people, to be a bit more creative maybe in this market than in the 2021 market.
Yeah, absolutely agree. And, you obviously fell in love, though, with venture capital because you wrote a book on it. You wrote a book on how to raise a venture capital fund and what are some of the most, things that people need to know about when raising venture capital. So question was like, what made you want to write a book? And what was the most surprising things you learned during that process of writing a book?
Yeah, I wanted to write the book for 2 reasons. One was to solidify my thinking around what I thought I knew. And 2 was to create kind of an asset for the ecosystem that would be helpful, because I saw how hard it was, right? And I was at a large firm with a relatively large budget, and it was still hard for me to build a fund. So imagine you take away the budget, you take away the resources of a large Fortune 500 company. They're raising a $5 million, $10 million, $20 million fund. That, I think, is a very important part of the ecosystem. So how do you help that person make it a little bit easier? So those are the 2 things: solidify my thinking and kind of make it easier for people that like emerging managers that I view as having like a very pivotal role in the innovation economy.
And I mean, it was about democratizing access, right? I think that's the thing that you want to get across, the access to the information, maybe?
Access to the information, absolutely. But again, I wrote it as a guidebook, and I rewrote it a couple of times before I published it. I started writing it in 2018 and I published it in 2021. So I mean, to give people a sense of, writing a book takes a little bit of time. I wrote a book that was actually 3 times longer than what was actually published. And eventually I just made sure like it was more like a guidebook, right? Something you could like refer back to, if you're trying to have an outcome in mind at the beginning, like if you're trying to say like, I want to raise a fund, what are the different pieces to be more successful or at least increase my probability of success? Like the book I wanted it to do that. The other kind of maybe perspective is a lot of people know Brad Feld's book, Venture Deals. It's written from the venture capitalist perspective for founders. So I'd say that book is more valuable to founders than it is to venture capitalists, right? And so I did the same thing with How to Raise a Venture Capital Fund. It's written from the LP perspective, but for VC founders. So it's, in my view, it should be more valuable to venture capitalists who are, again, starting their own VC firms than it is to LPs. LPs can use it as well. But again, it's the same kind of corollary, I think, that holds. I felt if you have 2 sides of the table, the LP side and the GP side, this democratization theme, like a lot was already known because people have been blogging about it, writing books about it for 10 to 15 years. Like there was that kind of transparency arc that happened between like founders and VCs, but it hadn't happened when I started writing this between like GPs and LPs. Right. I actually wrote a second book that I, announced recently called How to Set Up a Venture Capital Fund, which is kind of like you have to do those 2 things. You got to raise the fund and you got to set up the fund. Right. And so it's like, again, it's another way to kind of give back and organize the information. Because like the other piece at that time, people were saying like, and we were doing blogging at Sapphire for, years before I launched the book. Right. But there are only a couple of people on the LP side that were doing blogging. And then you had to like stitch it together. And even if you stitched it together, there are these huge gaps in like the knowledge base. And so you couldn't, as like a first-time fund manager, really put it all together. Like you had to figure it out. And then it goes like months or years later, right? It was just like, how do you put it into one organized thing that people can read? And then they're just ready to rock. That was the impetus behind kind of writing a book.
That makes total sense because you have books out there that always focused on like the investing part or the journey of like getting to that unicorn outcome, like Sebastian Mallaby's Power Law, where all the stuff that happens before you set up a fund and before you even raise the fund was never really discussed. And thank you to the Sapphire team for Open LP, right? And the conversations around that and the more transparency around LPs and now family offices is making it a lot easier for first-time fund managers to even understand what happens behind the scenes and the conversations that need to happen along the way. But obviously, this book led to the creation of what you're doing now, which is Coolwater Capital, which I believe you started during the pandemic. I mean, can you tell our listeners a little bit about your vision for wanting to start this like incubation style platform for launching new emerging fund managers? And maybe describe like the mission and the impact that you want Coolwater to have with the accelerator program.
Yeah, so I think that ties it together nicely. So, OpenLP was basically like an aggregation of information. Like it wasn't developing new information. So when we started OpenLP, that was the intention. It was like, how do we kind of co-brand with this movement? How do we, Sapphire was trying to be helpful. And like one way to be helpful was to create kind of this standalone platform that aggregated all the information out there. But again, there still wasn't a book that kind of like told you how to kind of start a fund or raise a fund. So even like OpenLP I'd view as like an aggregator. And like the book was kind of like, hey, I got to pull all this information together. I think I know how to do it. Let me like in an organized way kind of write it all down. And then like, yeah, give it to the ecosystem. OpenLP was aggregator. Book was kind of this like very focused way to help. But even then, like there's a difference between reading a book and implementing and building. You can read a book about starting a company and then you can start a company. Like they're they're 2 very different experiences. So I think that was kind of like the third iteration. Like if OpenLP was iteration 1, the book was iteration 2, starting this incubation program was kind of like the practical approach. Like how do you implement some of these things that I was being asked questions about for years? I was investing in emerging managers since 2011. For me, like I was getting questions literally hundreds of times about like the same thing. You can aggregate that or you can write a book and kind of like say like, hey, instead of me sitting down with you for 5 hours, read my book and then come back to me and ask me like specific questions. The actual build process of launching a fund, if there are listeners out there that are, have gone through that experience, like it's not straightforward. You need to kind of implement over time and iterate and adjust. And, there's strategic positioning there. There's evolution, like Fund 0 looks very different than Fund 4. I think the idea behind creating more of a system or like an accelerator or an incubator, like around this information, like, again, like you can have the information, you still have to like operationalize it, manifest it, implement it. So that was the idea there, was like, I think we're doing some good things. We're putting out content, but again, content is very different than building.
Honestly, I wish this type of stuff was available when I went out to start and raise my first fund in 2018. Like, first off, there wasn't as much content around, you're right, the fund formation, the LP fundraising, all that journey. Then the implementation. There was no accelerators in 2018 really that I could have applied for. And I didn't come from any fund, let alone a brand name fund. The only thing I was able to do was, one, reach out to other GPs who had already successfully, raised their first few funds. Some were incredibly gracious with their time and offering support and introductions. Some told me to never get into venture capital, that it was the worst business ever. And I thankfully didn't listen to them and used that as almost motivation. But then again, I also had to listen to the LPs that I was fortunate to have some relationships with on the family office side to ask them for their perspective of venture. And that may have also skewed my views as well, because certain LPs have different views of venture capital in general. So, wow, like I wish there was something like a Coolwater Capital Accelerator program, but it started after we'd already finished our second fund. But, maybe just for the listeners who are starting out now or have just started to kick off their initial fundraising process, maybe you can share some of the most common pitfalls you're seeing and hearing that emerging VCs are facing when starting their first fund.
I started iterating on this concept in 2016, and I think it came off the back of like getting the same question over and over and over again. So yeah, it was like, what are the things that I can help emerging managers understand upfront? It's very personality driven from my personality, which is like, if I want to learn a new subject, like I'll try to read 5 or 10 books on the subject or listen to 5 or 10 books and wrap my head around it that way, versus like tease into it over time. Like I kind of want to try to understand the big picture up front. And I think that helps, to your question, avoid some of the pitfalls. But yeah, I think the common pitfalls are sometimes going to market too early. And this is what I talk about in my book as well, which is the self-assessment exercise of knowing, how good of an operator are you? What is your actual track record? Like how good of an investment track record that is? Do you have the bigger picture perspective to really understand like where you sit? Like, are you top 1% or bottom 1%? I don't think a lot of people have that perspective. And it does help to have that perspective. And I'm not saying like you need to have all the boxes checked before, going to launch a new fund. I think if that were the case, like you'd never have an emerging manager. There's kind of but there is a kind of criticality point where, you get to a certain level. And, I see this with the most, I'd say, sophisticated investors with their go-to-market. Like they deliberate a lot more. And they kind of like plan a lot more. Like some people, I had someone at a tier 1 firm come to me and literally tell me that, he was going to spin out in 5 years. It turned out to be like 3 years and then he did it. But I was like, that's maybe a little too, premeditative. For most people, it's probably like a year or two in the making where they're like thinking about it. Sometimes it's 10 years in the making on the investment thesis, right? Like if you're a family office that kind of like starts to raise like third-party capital, you might have been investing into venture capital for 10 years and like honing that investment thesis over time. But your go-to-market is very strong. Like you have a very tight thesis, a very tight strategy. You're confident, or at least you think you're confident, to understand like what's going to make money and what your strategy is going to be. I think some people start a little too early and they're kind of figuring it out. And that makes like the fundraising journey a bit tougher. But I definitely think that's a big pitfall. And then another one is, I don't think, and this is kind of, in line with what Coolwater does, I don't think emerging managers appreciate how much LPs, especially institutional LPs, care about the fiduciary aspect and the operational aspect of your firm.
So true. Oh my God. Thank you for sharing that.
There's a dichotomy here, right? That should be called out, where, again, Coolwater, I think the reputation is it's like overly institutional. right? I'm not saying like build something that creates bureaucracy and detracts from, outperformance and alpha, but there is something that's like too little, right? Like if you, build a 4-wheel car with 3 wheels, like something's missing. And no matter how much like, you think you're good as a salesperson, like you're not going to sell the car until like the 4th wheel is there. Right. So it is that idea of like, do you know what the full picture looks like and how it should work? And if you don't, no matter, even if the other 3 wheels are greased, like it's just not going to work for you at the end of the day. That is something that I've noticed really hasn't ever been fully appreciated. I think the best managers, fund managers, like know they need to do it. Obviously, it's going to get deprioritized relative to fundraising and investing, but the best ones kind of figure out a way to do it and I would say not probably, I'd say invest into that part of their business early, maybe even to the detriment of their own salary. But they tend to do, the hockey stick growth versus some other people. If they don't reinvest into the business, it's a little bit harder to grow over time and kind of land those bigger institutional partners.
I mean, it's literally like you've been following the journey we've been on since the beginning, or literally I was listening to you in my head before starting. But there's 2 things that you say that resonate with me. One is when people say management fees, I think of how much do I have to spend on the fund infrastructure to get this thing up to the level of where it's actually getting value back to my LPs, not how much salary I can take. So I didn't take salary for the first 4 years. What did that mean? That meant getting the right finance team in place, fund administration, reporting, legal and tax structure, whatever it is, all those types of things. And then the other thing that you talk about was the 4-wheel car. And 1 wheel is like your deal flow, right? Like that's just one part of the car. The other part is on transactional, reporting, fundraising, communications. Like there's so many other parts. And for me, I actually spoke to GPs who are on fund like 7, 8, 9 vintages and asked them what they would have done differently at the very beginning. And that was some of the feedback they gave me. And then I left the VC asset class completely and spoke to private equity fund GPs and asked them what they do from a reporting standpoint and LP communication standpoint, and asked them for some templates and started modeling it after that. And that was a huge learning for me, because if I only stuck within like the early stage VC GP community, I would probably not have got the same feedback.
Yeah, if you want really good LP reporting, work with a fund in Germany or Sweden or just generally in Europe. Like I think the standards for LP reporting are so much better there.
It's true. I don't know why. I mean, maybe it's because there's more government capital or some requirements, from the regulatory standpoint that they have to adhere to on reporting. It's a great point. And we've had to learn from that as well. But, talking about the importance of understanding the uniqueness of like the LP world versus the GP world, what is Coolwater really doing to help bridge that knowledge gap when you're trying to understand the uniqueness of the LP side of the equation?
The way Coolwater works is there are several different programs. I mentioned 2 already. Like one is the core program called Build, that's helping you kind of put together your fund product and help you understand like where you're strategically positioned in the ecosystem and like how to run your fundraising strategy the best. That's a single program. I think talking about that program specifically, vis-a-vis LPs, you need to understand like where you are in the journey. And like we have fund 3s coming to that program. We have fund 1s coming to that program. I think if you're a fund 1, really understanding like the LP archetypes and where you are in that journey and not spending too much time on the wrong archetype. I mean, this has been, I think, proven. It's been written about a lot in terms of like the high net worths, family offices, maybe a little bit of fund of funds, maybe a little bit of corporates, strategic people that kind of care about what you're doing, especially if you're a specialized manager. Like those are going to be the LP types that are relevant to your fund as a fund 1 or fund 2. But again, the other point of Coolwater is to how can you operationalize and institutionalize as fast as possible, which again, that's a balance. It's very hard to do. It's a balance of time. It's a balance of resources. It's a balance of like getting that knowledge. But the faster you can do it, I think the more probability you have of actually being successful in landing kind of a different archetype, a bigger fund of funds or an endowment or a foundation. And I'm not saying that's true, but generally, right? Like I'm generalizing here, but generally that's true. Like as a fund 1, you're most likely not going to get an endowment. Some do, right? But again, it's like, do you know if you're one of those people that should be spending time in cycles talking to endowments. Because the dirty little secret, that's not really a secret, is LPs are information gatherers. Nothing wrong with that. They're trying to inform their perspective on what to invest into. And if you'll give them the time, they'll take the time many times. So I think you have to balance like someone wants to talk to me to what's best for my business and my fundraising strategy. And I think you kind of seeing the fact pattern of like who invests in emerging managers, internalizing that and operationalizing that at your firm to kind of say like, hey, I'm going to, limit or cap the amount of time I spend talking to institutions, which are, arguably some of the smartest LPs and investors in the world who will give you good market perspective and give you good advice. Like getting advice from someone that's made 100 investments into a fund, like across funds, across different asset classes, that could be good advice, right? Like you probably want to talk to that person or some percentage of your time, right? To your point, like break outside of the bubble. But at the same time, like if you're trying to get your first $10 million fund off the ground, you probably don't want to spend 80% of your fundraising process like talking to those people.
Yeah, getting to that first 10 million or something is almost more time sensitive, I think, than, you're right, the endowment conversations. Not everyone's going to have like a first fund like Footwork with like NBT and the way he came out oversubscribed on like a $250 million first fund. Getting into the nitty gritty a bit, what criteria do you use to kind of select the VC that you accept into the build program? And what does the 8-week process look like, during that training program?
I think of the world in terms of like basically two buckets. There's the emerging manager criteria and the institutional criteria. So when I was at Hall, when I was helping build the fund of funds at SAP, Sapphire, that is, I would say, more institutional criteria, right? Like you need to hit more check boxes in order to like meet the hurdle and get into the portfolio. For Coolwater, what we're trying to do, right, like you asked about the mission earlier, is support the innovation economy by supporting emerging managers, right? And so I think we have to be more flexible with our investment criteria. And I wouldn't even call it investment criteria. It's like trying to support people we believe are going to be long-term oriented fund managers, acting as fiduciaries, like, being stewards of LP capital, and they're great investors. And so we're looking for, again, great investment acumen. Like you have to have some pattern of investment. Like it could be an angel, you could be working at a smaller VC, you could be working at a bigger VC, like you could have gone through the apprenticeship model, you could have worked at a VC-backed company, right? And like what VC is, like it's this very specialized high growth technology investing strategy. Kind of have to have that background of like knowing what VC is through investing or through operating. That's really key because again, I think VC is just one of many models in which you can like make money as an investor. But that's a key point. Like even if you're an emerging manager, like you can't be an emerging manager in VC if you don't have the background and exposure to VC in the past. And so that is something that's like we look for. Also looking for, I'd say a bias towards like management. Again, fund manager, like management. You have to be kind of biased towards managing the fund. This is probably why when you're talking to your GPs in the past, like these people were trying to push you away from it because it is a management exercise. And outside of Coolwater, I don't know any other program on earth that actually like helps you get an MBA or get like a management degree for running a fund, right? And so it's looking for someone that's aligned with that wants to do that, because there is a difference between angel investing and fund management, a big difference, right? And like to your point, like everything you mentioned on the legal, the tax, the compliance, the back office, that's all management. That's not like investing. And like the angel stuff is like investing. The fund management stuff is, now you're starting to get into the kind of nitty gritty. You need to be aligned there. And I'm looking for that. I would say I also challenge people, do they want to be fund managers, especially if they're angels, right? Because probably being an angel, it's arguably less work. It's definitely less work than being a fund manager. So it's really something you kind of want to be like, aligned long-term around if you want to do the fund manager game. And then I'd say, community orientation does help, right? Like it does seem like there's a certain personality that kind of qualifies for the Coolwater community, where if you just want to be a lone wolf, like that's fine. Seen some people be successful doing that. I think if you buy into the fact that you can get further by growing the pie bigger, that is like the community element of Coolwater. Like it does seem like we're looking for that as well. Like we want people that, again, are going to run great businesses, and not make bad business decisions, but they are going to have that personality that's a bit more like community oriented, because like, if the pie is bigger and everyone's sharing in a piece of that larger pie, that's actually attractive than if like you just kind of stay small and kind of insulated. Again, I think both models can work, but I think for Coolwater, like we're looking for that on the emerging investment criteria. And then the last thing I'll kind of touch on is like, don't need all the boxes checked. Fundamentally, we're looking for someone that has like, again, really strong experience in VC, right? That doesn't mean like DPI, that doesn't mean like a 10-year track record, but someone that like has a right to win deals and can like pick and win access into great deals. And then we want to like work with them and just see like, is this something they want to do longer term? That's the point of like that core program for build. And then again, we don't think you need to know everything coming in. So we have like this huge kind of like alignment around like institutional criteria, and we can help you go from like that emerging criteria like that, you're great, you're special, there's something here that may give you a right to win. We can help you kind of bridge the gap between the emerging and institutional, right? Which makes you eventually, hopefully sooner rather than later, more attractive to institutional LPs. And yeah, that core program, runs over 2 to 3 months. The kind of 3 big pillars are fundraising, what I just mentioned on fund management, and operations in reverse order. Like you got to get the ops kind of set up initially. Like you don't want to build too much. You don't want to build too little. You kind of want to build like the Goldilocks version of your fund, especially for fund one, so that you're not wasting money, you're not wasting time, you're not under optimized, like you are optimized. Then the fund management stuff, there's all these new concepts that come up. Like you go from angel to fund manager, these new concepts of portfolio construction, other things like you need to know. And they're critically important, right? It's like learning a new language. Like you can't go to a country that speaks a different language and like you expect to just like everything's just going to like flow like very smoothly. Like you have to like learn the new language of being a fund manager and understand like these new business processes that are core to you running a fund. And then lastly, on the fundraising piece, it's like, how strong is your fund product? Do you understand the full market? I met with 1,010 fund managers last year. That's a big number. Not all of them are going to be successful in raising their fund. You need to know, like, did everyone else meet with 1,000 managers? Probably not. But like, if you meet with 1,000, you have a perspective of what the market looks like. What is the top 10%? The top 10% of 1,000 is 100 managers. What's the bottom? Most people meet with like 100 or 200 managers. So is that the bottom 20% or is that the top 20%? Right? Like you're missing 800 to 900 names. And that's like, I don't even think I saw the full market. So I think like for me, I think that fundraising piece is, it's when I say strategic positioning, it's understanding like, where do you sit relative to all the other funds out there? And do you have a perspective to make yourself better?
I've seen it. I've seen it too. Like I'm an LP in half a dozen funds as well. And I tell them the same things you're saying. It's like, do you want to be an angel investor full-time or a fund manager full-time? Because for me, managing a full team, doing, quarterly reviews on employees, having all these LP conversations, putting all the reporting together, having weekly calls with your fund admin and your CFO and your taxes and your legals, like that doesn't even scratch the surface on the investing side, which also dedicates a huge part of time. So it's a crazy different world between a fund manager and just an angel investor. What we, venture tourists.
Are you becoming your mentors? You're telling other people not to start funds in this market environment?
No, never. I'm doing the same thing I'd tell our founders, which is just, no, it's going to take twice as long as it's going to be 5 times as hard. So just be prepared. That's all it is.
Yeah. That's bigger. I was saying, it's for the fundraising market, 2024, it's like versus 2021, it's like twice as hard. You're going to raise half as much, but maybe it's like 3 times as hard and raise a third as much.
I would never tell anyone not to do anything that they set their mind to. I would just like to give them the guardrails or the truth around what it's going to be like, so that they can maybe just see around the corner, which it sounds like you're doing very well with Coolwater.
You don't want to like discourage people. Like this is some people's life's dream and you have to encourage that. And again, the point of this Coolwater build program is to help give you, again, the greatest probability of like manifesting that dream. That's the point of it. And again, some people, a super minority, but some people have decided like, I actually like angel investing. Like I just, someone came into the last cohort, writing 100K checks into angel deals, had the ability to do like a big GP commit, like have a really strong foot forward, like in their own fundraising process. But they came to the program and kind of realized that they didn't want to be a fund manager and do all this other stuff that you're mentioning, right, on the management side. And like they're like, oh, I'm all of a sudden becoming the CEO of my business, which is going to like take 80% of my time. and all I want to do is invest. Like I'm having a lot of fun investing, and maybe they come back in 2 or 3 years and like they kind of have a change of heart. But Coolwater program is intense enough for people to get to that decision, right? You can also like as a team, you're maybe like 2 people saying like, hey, I want to go through and see like, is this the partner I want to date in a very intense way that I'm going to spend the next 20 years with? And like you force yourself to co-invest together. You force yourself to build together. And some people decide like, actually, this isn't the person I want to build this with. Let's split up. Or some people say like, actually, yeah, that confirmed my original hypothesis. This is the person I want to build it with. So you can use like Coolwater in different ways, like to kind of get to, similar outcomes. But yeah, like the name of the game isn't to like discourage people from realizing their dreams, especially if they have the background. They're going to be like very helpful to founders, right? Because building a company just generally is hard. Founders of technology companies, they're kind of like the core kernel of all of this, right? And the emerging managers are like, they're trusted partners that are kind of helping that like company building journey for the tech founders go, more smoothly. I want to put more people into business that are helpful to founders. That's kind of the mission.
Yeah, I mean, I actually had some of our best founders provide feedback to me as an emerging manager on how to become a better startup founder as I was starting a fund for the first time. And it was incredible feedback. And I really appreciated it. Speaking of feedback, though, you obviously have a huge network beyond just the Coolwater cohorts. How does the network of your relationships and all the other people you've interacted with over your time in VC help benefit some of these emerging managers?
I think the numbers are like over 3,000 VCs and over, maybe it's more, 3,500 VCs and like over 3,000 LPs. So I don't know if that's big or small.
That's big.
That's judging off of like the database can be bigger. I know some people throw around like big numbers for databases, but like the question is like, will someone respond to your email? That's an exercise. You need to know like what people care about. Like my mind works. Like I usually, like if I have a conversation, someone tells me what they want. Like if a founder comes to me and asks me like, do you know 10 VCs, or they don't even put a number on it, but like, do you know any VCs that like care about my company? I usually know like 5 to 10 VCs off the top of my head. If a VC comes to me and they're like, hey, this is what I'm doing, I probably know 5 to 10 LPs off the top of my head that could be like relevant. It's harder, I think, to make that introduction to the LP, right? Because like there's only so many shots on goal. And if you're like, this is the dichotomy of like running a community and kind of like, right, like I could just make endless amounts of intros all day long and I could fill 24 hours a day nonstop forever, right? Just in terms of like the demand for people who want LP introductions. So the way I've tried to build a community is like in a scalable way, right? Like that's why we have programs instead of doing one-on-one consulting. And I think that's the same way. It's like, how do I leverage the network I've built, which I think has been iterated a lot on, but it's like for the most part, emerging manager centric, LPs that care about emerging managers that are emerging managers, founders that are early and probably raising like a big part of their cap table from emerging managers. Like that is kind of the network. It's like very emerging manager, kind of early stage venture centric. It's a very hard exercise. Like I spend multiple times a week, like thinking about it and always feeling like I'm failing at leveraging the value of my network enough. Like I haven't found the perfect tool, the perfect AI. I have recently turned myself into an AI to like ask myself questions and answer questions better than I can answer myself. Like I should have had it up actually on the side here.
Well, what do you got to ask? What are you using for CRM?
The CRM. So we're going through this exercise now, but I've been using Airtable. I think maybe I'm using it incorrectly, but the problem I have is there's too many bases, right? Like there's different programs. There's a base for every program. There's different networks. Like I just mentioned, like 3 networks I have, but there's more, right? And like there's no like centralized database with everything. And then I can run like different projects off of that centralized database or introduce new projects. So there are some like constraints to using that. So we're going through an exercise now. And I don't know if you have a...
honestly, like our tool set is the following. We use Affinity for deal flow management, just deal flow management. We see 10,000 companies a year. We use Dex for contact management, which I recommend highly. It's a fantastic tool because it pulls in from all different network platforms and then also has these reminders and these notes and everything. So that's our contact management. We use Notion for all of our project management, for all of our projects and stuff and templates and stuff going on in the organization. And we use Otter AI for transcription of all of our call notes and recordings. And then we train our own AI off a knowledge base that we've created for feedback, for people to ask questions to, powered by our portfolio company, VoiceFlow. I mean, like, look, the role of technology in the world of emerging managers is going to make the ability to have really efficient and productive solo GP funds running institutional capital, in my opinion. Not that I want to be a solo GP. I'm just saying we are a small team and we still are operating, as I've been told by some firms, bigger and more efficiently than larger 75-person private equity or venture capital firms. What other trends are you seeing, I guess, shaping the venture capital industry that you're excited about while you build Coolwater?
AI, like there's this dichotomy right now of like AI making it easier in a way to be a smaller firm, but there's so many firms that have started. There's like a consolidation theme, like a lot of people thinking about it, but it's tough. Like if you want to scale up, you most likely have to consolidate, right? So I think, I don't know where that shakes out, but that is kind of a tension in the ecosystem right now where a lot of people are talking about it like, hey, I want to go from 20 to 50. In order for me to do that, I need to bring on another partner. That partner's running another fund. So for us to come together, right, like that's consolidation. But at the same time, like they're more effective because of some of these AI tools that are coming out. So they might be able to arguably run a $40 million fund or $50 million fund, and actually spend less time on the ops and kind of management side because like the tools are getting better and better. And so I think that plays out, right? Like we did have kind of the lower barriers to entry over the last kind of 10 or 15 years, allowing people to do SPVs and start funds and kind of get into the business, right? I think the next 10 years, like you kind of have like these AI tools that are making your job as a fund manager easier. So you might be able to like run more capital against that. You're going to have $1 billion AUM kind of single solo GP manager. Maybe there's a couple already, but again, I think that takes a while. I think you're more likely going to see consolidation in the near term than kind of AI leading to like a more distributed ecosystem. I think we're seeing like, I don't know if these are trends or kind of things I'm seeing, but like LP defaults, there's a lot of LPs that kind of came in on the last wave that actually don't want to do venture. And maybe they even couldn't from like a liquidity standpoint. There's some of that going on, and there's funds sprouting up around that. You might see, given the bank failures that happen, like I think there might be maybe a gap in like the debt side and kind of the ability to kind of like give more kind of runway on the debt side to companies. Like maybe there's some funds that kind of step in, kind of fill that gap. Like I'm seeing stuff more on that side. Like there's still a lot of fund formation going on. Like even surprising to me, hundreds of managers like still out kind of like starting funds, despite there being like a slight shift in the fundraising market over the last few years. And they're I think they're for the most part like meta level, like targeting some big themes and some big problems. Climate and energy transition, it's not going away. Like AI, people can argue about whether or not like pricing is too high or too low, usually too high. That's not really going away. So I think there's like, you're kind of seeing fund formation kind of attacking these like bigger opportunities or bigger kind of challenges that are out there that, humanity is going to have to solve. And I think venture, is kind of like the world's R&D. So I just think you'll continue to see like fund formation around those themes that's not like new information. There's really smart people that have more view on what venture is and how they can play a role. And so I think that leads to continued fund formation over at least the next few years.
I agree. My view of this is that you're going to have real, true early stage venture capital still exist, like we are, pre-seed focused primarily as an institutional VC, but capped out at a normal fund size of 150, maybe even 200 million, but that's pure early stage. And I think on the other end of the spectrum, you're going to have these huge asset gatherers like we just saw with the new $7 billion Andreessen fund pool that was raised, but that trickles into 5 different sub-funds. And I think you're going to see a lot of assets go there. What I do think you'll see is the hollowing out of the 500 to say $1 billion generalist funds that are competing for all the same stuff at the Series A, B, and maybe C stages. And LPs saying they want more specialization of that asset class rather than just generalist. And the fund sizes there can get the same exposure if you just join a bigger asset platform like a Sequoia Andreessen or something else. What are your thoughts on that?
Yeah, I've been seeing kind of the bifurcation happen for the last 10 years where the barbell of, you see the haves and the have-nots, and like people say like the haves are the asset gatherers, like the bigger firms, like with the, tens of billions in AUM. That's definitely like, if you can do it, it seems like those firms do it. They keep on like raising larger funds. Is the case there to like drive outperformance, like what venture is known for? Are you going to get the 5X fund by raising $10 billion? Time will tell. But I think, my view and kind of where I'm putting eggs in the basket is, I think if you, do the right manager selection for smaller funds, that maybe sub $150 million bucket you were referring to, like, I think if you're doing the right manager selection, partnering with the right managers there, we're able to navigate nimbly based on fund size, based on experience, based on acumen, the investment market. I think they're going to continue to build like attractive portfolios. And again, like there's so much capital has to be deployed into technology. I don't really think about it as like there's a mid tier there. You can mention the 500 to $1 billion. Like I always think that's going to be there. Like there's just always going to be bigger checks after the starting checks, right? So like where Coolwater spends its time mostly is like that starter category, right? Because like that's harder for discovery. It's harder to like understand the technology. It's harder to understand like before there's, product market fit, meaning like these technologies are actually commercialized and, selling to people. That's the hard piece still. I think there's always going to be like capital downstream. And so, yeah, if you have the opportunity to be an asset gatherer, you're going to most likely do that. Like that's what I've seen in 98, 99% of the cases. But for emerging managers, like you still have to be special and have a right to win, right? And that's what Coolwater is trying to focus in on and, invest into.
Yeah, I mean, I love what you're building and I love what you're doing for the ecosystem. So cheering for you and wish I was able to join a Coolwater when I first started out.
Never too late.
Never too late. All right, I'll apply to the next build cohort. Before we wrap things up, we always ask our guests for their fast favorites. First is your favorite podcast.
I mean, Tank Talks, All In. Like my wife loves the All In podcast, how I built this. Like some of these like ones where I think my favorite podcasts are the ones that like talk about like how something has been built. Like
Acquired FM guys on the Renaissance Technologies. Yeah.
Anything like that is like my favorite.
All right. Next is your favorite newsletter or blog.
Pretty boring here. I just go like with the standard rags that kind of like let me know just what's going on.
Strictly VC, the information, one of those?
More like strictly VC or like term sheet, just something that like gives me like the actual like what's going on in the business. And I spend maybe 5 minutes reviewing that in the morning.
Too busy. Next is your favorite tech gadget?
I'm on my phone for 4 or 5 hours a day. So
you're not reducing screen time, essentially.
Not reducing screen time, really. I think like without the mobile device, like given how much I traveled, I think I traveled like 40 or 45 weeks last year. Without the ability to do like remote work on a phone, it'd just be like impossible to run the business and actually like run as big of a community as Coolwater is now.
Amazing. A favorite new trend?
Either bigger firms buying smaller firms, which is starting to happen, or like the dance you do of peacocks mating when you're like merging, not emerging managers, but merging managers.
Very interesting trend. I think I know the answer to this one, but your favorite book?
I think the most like informative book for me as being an LP is like Pioneering Portfolio Management, David Swenson's thing. Like I've read it a couple times, and I do think it helps like that multi-asset class thing. Like reading that as a VC is helpful. Obviously, I think my two books are helpful: How to Raise a Venture Capital Fund, How to Set Up a Venture Capital Fund, and then some other like fun books like Catch 22 and books that kind of make you think about just the complexity of the world.
Yeah, absolutely. And last but not least, your favorite life lesson.
I think like doing something for so long where it like sheds all of your ego and gives you empathy. The experience of like having done Sapphire and like having like gone through the experience of like building something and then being able to like build a company around like that and like just have the empathy for something else that other people are doing. I don't know if that's a life lesson per se, but I think that's how I kind of like go through life. Like I'm always learning by doing.
It's a framework. Yeah, I love it. Well, thanks so much for joining us in the tank today with Winter Mead from Coolwater Capital.
Thanks, Matt.
Hey, everyone. Thanks for tuning in to another episode of Tank Talks. We hope you found today's conversation as insightful as we did. If you're enjoying the show, we've got 3 quick things to ask of you. First, hit that subscribe button on your favorite podcast platform so you never miss an episode, whether that's Apple Podcasts, Spotify, Google Podcasts, or YouTube. Next, follow us and stay up to date on upcoming episodes and behind-the-scenes content. on social media with Twitter, LinkedIn, and Instagram. And lastly, share the love. If you found value in today's episode, share with a friend or colleague who'd benefit too. Your support helps us bring in more amazing guests and keeps the Tank Talks engine running. That's it for today. Until next time, keep disrupting and innovating.